Hello and welcome to the webinar. My name is Karen Nichols. Today's presentation is offered to real estate owners and advisors to help them understand several techniques for real estate investors to defer or reduce their income taxes. During the webinar, you may ask questions using the GoToWebinar controls located in the upper right corner of your screen. We will take questions at the end of the presentation. The information contained within this presentation is provided for informational purposes only and is not intended to substitute for obtaining accounting, tax, or financial advice from a professional tax planner or financial planner. Presentation of the information is not intended to create, and receipt does not constitute, a tax planner-client or financial planner-client relationship. Viewers and readers are advised not to act upon this information without seeking the service of a professional tax and/or financial planner. Bedford Cost Segregation is one of the largest providers of cost segregation services in the industry. Established in 2002, Bedford provides tax reduction services to real estate owners nationwide through its staff of over 60 tax, engineering, and support professionals. Bedford has delivered over 10,000 cost segregation studies to date. We are a founding member of the American Society of Cost Segregation Professionals, and we provide an audit defense warranty. I would now like to introduce today's presenter. Jeff Glass is Bedford's Business Development Manager for the West Coast region, where he works with CPA firms, developers, and real estate owners to assist them in obtaining the tax advantages afforded by cost segregation. He has a special expertise in applying the IRS repair and capitalization regulations and often speaks to groups on this topic. With that, I'd like to turn it over to Jeff.
Thank you, Karen. Good morning, everyone, and thank you for attending today. I'd like to begin by observing that most real estate owners are probably paying more income tax than they're required to pay, and perhaps by quite a lot. And the reason is that they and their tax advisors may be unaware of their opportunities for income tax reduction permitted by the IRS. So during the next half hour, I want to help you get a basic understanding of what these opportunities are so you can take advantage of them for yourself and your firm. First, we're going to look at how you can defer income taxes by accelerating depreciation deductions. And I recognize some of you may already know about cost segregation, but I'm hoping that you'll find a few facets uncovered that you weren't aware of before. That'll be the first half, and then the second half I'm going to show you how to write off assets that no longer need to be depreciated under the tangible property regulations. Now, I'd like to tell you a little story to help set the stage. The first project that I was involved in that made use of this combination was about 2 years ago when the regulations were brand new. I had encountered a client who was the owner of a warehouse property that had been owned for over 20 years, and so it was pretty depreciated. And when I estimated the potential benefit for cash flow from cost seg, the result was pretty modest. However, it turned out the owner told me that they plan to spend over $100,000 on a new roof in the coming year. And it dawned on me, because I was becoming aware of these new regulations, that if the roof job met certain criteria under those regulations, it would be possible to take that cost as an expense rather than depreciating the cost over 39 years. Now, in order to justify the decision to do that, the client would need certain data that a cost segregation study could provide. So what I recommended that they do is go ahead, get the study done, and be able to take some accelerated depreciation deductions. And in addition, they would be able to deduct the entire cost of their new roof, and that's exactly what they did. So I share that story because it provides a glimpse as to how cost segregation and the TPRs can be combined to help reduce income taxes and improve cash flow. So first, let's do a quick review of cost segregation and how it works. As many of you are probably aware, cost segregation is the IRS accepted method of taking accelerated depreciation on commercial or multifamily real estate. It's a strategy. It's for reducing income taxes in the early years of ownership, and it usually requires an engineering-based study of the real estate to make it work. Now, one way to tell that cost segregation is an accepted practice is to know that the IRS actually wrote a guide for it for their auditors on this subject. And it instructs the auditors what to look for in cost segregation studies during audits to make sure that they were done correctly. Now, that's not to say that cost seg is an audit flag, because it's not. And in fact, for studies that are done on a look-back or retrospective basis, the taxpayer doesn't even have to file amended returns for prior years, but instead they simply file Form 3115 to take the catch-up depreciation deduction in the year that cost segregation has been applied. Now, this form is actually processed by the IRS on an automatic consent basis instead of requiring a manual review as any other change in accounting method would require. Now, it doesn't guarantee that you won't be audited, but the vast majority of cost seg studies are accepted by the IRS as a matter of routine. So who's a good candidate for applying cost seg? Well, if you own commercial real estate and you can use additional deductions, that's a great start. And you should at least consider having an estimate prepared to see what the outcome would be under some reasonably conservative assumptions. Now, cost segregation also is going to provide good results if you've owned your property for no more than about 15 years and if the initial cost basis of your property is at least $1 million. Cost segregation also potentially can be applied in the year of sale for properties that have not been owned for more than about 15 years, and that would be done to offset any taxable gain on the sale. Now, cost segregation came about as a result of a tax court case. In 1997, Hospital Corporation of America successfully argued that hospital buildings and commercial buildings generally contain a combination of long-term real property and shorter-term assets. And these short-term assets include things such as land improvements surrounding the building and various types of tangible personal property inside, such as flooring and wall coverings, special mechanical, electrical, plumbing systems that are there for specific functions that are undertaken by the occupant. And that case was made using an engineering-based study to support the claims, and the outcome of that gave rise to the cost segregation industry. Nowadays, when a real estate owner first builds or acquires a property, they usually have their accountants set up the non-land portion of the cost on the depreciation schedule as a single line item with a 39-year depreciation period, or 27.5 if it's residential. Now, when that's done, it can mean that the property owner will be overpaying their income taxes in the early years because whatever short-term assets that happen to exist will be depreciated over an excessively long time period, and the owner will miss out on their near-term depreciation deductions. Now, if instead the property owner has a cost segregation study performed, the cost of the non-land portion of their asset can be broken down into the long-term components and the shorter-term components, namely the 15-year and the 5-year personal property. And if that's done, the depreciation can be significantly accelerated, reducing income taxes during the first few years of ownership. The magnitude of the cash flow benefit that can be anticipated in net present value terms is usually somewhere between 4 and 8% of the initial cost of the improvements. Now, the mix of the different types of assets that are going to be found in a building depends quite a bit on the property type and, of course, on the individual property itself and what the owner has put in them. We can make some generalizations. So, based upon our experience at Bedford, and as seen in this chart, if you were to take, say, a garden-style apartment, that's typically going to have somewhere between 20% to 40% of its cost that can be reallocated from long-term real property into shorter-term land improvements and some personal property. By comparison, if you had, let's say, an auto dealership, that might have anywhere from 30 to 60% of its cost in short-term assets. Now, to get a better idea of what some of these short-term assets actually are when we do cost seg studies, let's take a look inside this familiar environment. We've got a grocery store, and let's see what we find. The IRS permits many of the things you see in this picture to be classified as personal property. Let's start on the ceiling. The fluorescent ceiling lights are considered the main lighting, and those have to be depreciated over 39 years. But the track lighting is considered personal property with a 5-year depreciation life because it's special use. It serves the function of illuminating the produce display. We've got many other items in this picture that are also considered 5-year because they support the specialized function of grocery retailing. Now, individually, these assets may seem pretty minor in terms of their cost, but they can really add up. Same thing outside. We've got land improvements, and those are generally anything outside the building that's not the raw land. Now, seen in this photo, you've got things such as The asphalt paving, the concrete curbs, the landscaping, irrigation, fences, and whatnot, these are all considered 15-year assets by the IRS. One major exception is if you look outside in your parking lot and you see the big light poles with the light heads at the top, those are generally treated as a 5-year asset. It's a kind of a special case. When a cost segregation study is completed, each and every component comprising the building and the surrounding land improvements are all itemized in detail, and they're assigned an individual cost and the correct IRS accepted depreciation life. Now, all these costs are summed up and they need to be reconciled with the total cost of construction or acquisition plus any additional capital expenditures that have been incurred along the way during the period of ownership. And that's the level of detail that the IRS would expect in the event of an audit. Now, this chart illustrates how cost segregation is going to shift some of the depreciation expense to the early years of ownership. Suppose we're looking at a 39-year time period. The red line represents straight line depreciation for the entire set of assets of this property over 39 years. The blue line shows how writing off some of the costs faster results in a lot more depreciation expense in the first 6 to 7 years, and that's going to reduce taxable income in those years. The green line at the bottom illustrates the increase in the after-tax cash flow that results from taking more depreciation deductions in the early years due to cost segregation. So this is all about time value of money. We know that lottery winners usually prefer to take a discounted lump sum up front rather than that small stream of payments over many years that they're offered. And it's similar with cost segregation. Real estate owners are usually a lot better off taking their depreciation deductions sooner just due to the time value of money. There's a popular misconception that I run into quite a lot about cost segregation, and that is that it must be done in the year a property is built or acquired. That's not true. In reality, many property owners, in fact, most of the projects that I see for cost seg are actually done on a retrospective basis, usually because the owner hasn't heard about cost segregation until after they've owned their property a while. So by way of example, let's look at a hypothetical office building. Let's say it has a depreciable basis of $10 million, and 15% of that is 5-year property and another 10% is 15-year property as determined by a cost segregation study. Cost segregation would deliver an after-tax cash flow benefit of about $622,000, assuming a 40% tax rate. Now, let's compare the cash flow pattern of cost segregation applied at 2 different points in time. If the study were done up front at the time of acquisition, the tax benefit would be spread out over the first 6 years. And if instead the owner applied cost segregation in the beginning of the 6th year of ownership on a retrospective basis, they're going to get the same cash flow, simply delayed. So the benefit is still significant, which is why we see so many look-back studies. As I said earlier, the magnitude of tax benefit that you can get from applying cost segregation is usually in the range of 4% to 8% of the depreciable assets. So if you've got a $10 million building, we're talking about $400,000 to $800,000 in tax reduction, possibly more depending upon what's in and around the building to be segregated. You can do cost segregation on all kinds of buildings. You can do it on small properties. Here's a little freestanding building that happened to be a beauty salon that I did a while back. Had a basis of just under $1 million. You can do cost segregation on small parts of big properties, such as a rental luxury condo. And of course, it works great for larger properties. Now, in addition to cost segregating complete buildings, it can also be applied to tenant improvements, which is usually a pretty good move because anything over $200,000 or so in tenant improvements is going to contain a high percentage of personal property, and that means there can be a very good outcome on a cost seg study of tenant improvements. Now, besides the usual cases of new construction or new acquisition, what would be some other situations that you should think about for cost segregation? Probably the most common one is an acquisition via a 1031 exchange. Now, in this case, what you want to do is just cost segregate the portion of the property's cost that is above and beyond the exchange basis from the relinquished property. That's the amount that you want to cost segregate. If there's a big renovation to a building over, say, $1 million in cost, that would be a good candidate for cost segregation, as well as tenant improvements, as I mentioned a moment ago. Whenever there's a step up in cost basis of $1 million or more, you should think about cost segregation. That would typically be triggered by a buyout or maybe the death of a partner. And finally, as I alluded to before, when a property that's never been cost segregated is sold, and if it's been held for no more than, say, 10 to 15 years, you can offset some of the gain on sale by performing a retrospective cost segregation study. In this case, let's suppose that they're exchanging, or they're not exchanging, and when they're not exchanging, they may be exposed to a gain. There could be a tax arbitrage possibility, and that's where the taxes saved by depreciation deductions don't have to be entirely given back through recapture. There are details on that are really beyond the scope of this quick presentation, but contact me if you want to know more about that. So, as promised, I'm now going to share with you some new ways to use cost segregation to reduce income taxes. And these opportunities exist if you hold real estate for long-term investment, at least 2 or 3 years, if you're depreciating the cost of repairs and maintenance improvements, if you're planning some significant expenditures on your property in future years, and if your current or future renovations will cause some big pieces to come out of your building and go into the dumpster, that is, retiring assets before the end of their tax life. So in this situation, cost segregation studies can help property owners to take advantage of some new options to expense many costs that in prior years had to be capitalized and depreciated over a long period of time. So this is big news. The reason that this exists is because we have some relatively new IRS tax regulations that change the definitions of what needs to be capitalized or depreciated over time versus what may be expensed. Now, these rules, usually called the tangible property regulations, are also known as the IRS repair and capitalization regulations. They came into effect in tax year 2014, and they represent a huge change in tax accounting for real estate. Now, the rules themselves are very long and complicated, and of course they're worded in a way that's vague and subject to interpretation, which of course helps the IRS. And it's been my observation that many property owners and their tax advisors have basically ignored these regulations. They haven't done anything about them yet, even though they offer some very taxpayer-friendly features, and even though failure to comply with them could have some unpleasant consequences. So let's go ahead and take a closer look at what these regulations are all about. Now, I'm going to nickname the tangible property regulations the TPRs. Under the TPRs, new definitions are given for what costs related to tangible property, including buildings, must be capitalized and what may be expensed in the current year. Costs that have to be capitalized start with what are known as facilitative costs. These are generally soft costs that can't be allocated to any specific improvements and usually occur prior to placing the asset into service. Now, for that matter, any costs that are incurred prior to going into service must be capitalized under these new rules. Next, we have a new definition of capital costs that I call BARS, which is an acronym for Betterments, Adaptations, and Restorations. Let's take a look at those. Betterments, in brief, are costs that are incurred to fix a material defect or add to the size of the building or increase the capacity of one of its systems, such as upgrading to a larger HVAC system. Betterments always need to be capitalized either over 27.5 or 39 years, depending upon whether it's residential or commercial. Then we have adaptations. These occur when you spend money to convert a property from one use to an entirely different use, such as warehouse to apartments or manufacturing to restaurant. Capitalize adaptations. Restorations are costs for replacement of major structural components or substantial structural parts of buildings. Now, clearly there's going to be some room for interpretation on that sort of thing, but these must be distinguished from routine repairs and maintenance costs, and the cost of restorations always needs to be capitalized. So that's a very, very brief treatment of what must be capitalized, and here comes a brief treatment of the other part, which is what may be expensed. And here's where the taxpayer-friendly features I mentioned are found. First, we have several safe harbors. And these provide some simple expense deduction options. Begin with the de minimis safe harbor. That's very similar to the old rule of thumb where your accountant would say anything over a certain amount gets capitalized and anything under that we can expense. So the de minimis safe harbor allows writing off any costs up to $2,500 per invoice or per item, and up to $5,000 if you or your firm happens to have reviewed or audited financials. Next, we have something called the small taxpayer safe harbor. If you meet the definition of small taxpayer, and you probably don't, but you might, you can deduct the lesser of $10,000 per year or 2% of your original building cost basis, whichever is less, and that cost basis must be no more than $1 million. So for most, not much help, but the next ones are really helpful. There is a routine maintenance safe harbor, and then specially defined deductions for things we'll call non-bar, non-material costs. And then lastly, you have partial asset dispositions. So let's go over these one by one. The routine maintenance safe harbor of the TPRs is very useful because many of the common costs that used to be capitalized now may be expensed. The idea here is that if a cost is incurred to help keep the property in, and I'll quote the IRS regs, ordinarily efficient operating condition, unquote, and it's expected to be repeated at least once every 10 years, then it can be expensed. And even if it's a large dollar amount, and even if your accountant used to capitalize this sort of thing in the past. I've seen property owners deduct hundreds of thousands to millions of dollars applying the safe harbor rule. So it can apply not only to current year costs, but retrospectively, and that's pretty exciting. Next, we have another rule that can be helpful. This rule you would invoke after considering the previous one. So in other words, if you could expense an item using any of the previously mentioned rules, you're done. But if not, then see if this rule will allow an expense to be taken. In this case, if the cost doesn't meet the definition of a betterment, adaptation, or restoration, and if it's not material in magnitude, it can be expensed. Now, the definition of material and the regulations can be vague, even though there are tons of examples given. The examples generally indicate a cost threshold of 30%, which I'll need to explain. So, for example, when 30 out of 100 windows in a building are replaced with the same type of windows, so it's not a betterment, that's not considered material, so that cost could be expensed. Now, when you think about that, inevitably there are going to be situations in which counting up items in that way won't work, such as when a new roof is put on. In that case, we can look at the cost of the new roof, assuming that it's not a betterment, and we can compare that dollar cost to the dollar cost of the building system of which the new roof is a part. And that brings up a concept and a tool that the IRS has introduced just for this purpose. They've got this concept they call units of property and the associated building systems. The building itself is considered the unit of property, and the roof is part of the building structure, and that is one of 9 building systems to be considered when applying this materiality concept. So here's a chart that shows on the left side the way a depreciation schedule might show the historical cost breakdown for a building, and in comparison, if you look on the right, you'll see the new IRS unit of property breakdown. And the total cost of the building is the same on both sides, but it's just broken down in different ways. The IRS breakdown on the right shows their 9 building system categories that can be used as the denominator in this materiality fraction. And the cost of, let's say, a new roof or some other component would be the numerator. Now, while the IRS doesn't explicitly state this in the regulations, it's our interpretation at Bedford that if a property owner who uses this type of breakdown and limits expensing items to those that don't exceed 30% of their associated building system, most likely will not be challenged on that point if audited, simply because of the strong preference shown in the guidelines or in the examples in the regulations for this 30% materiality threshold. Now, a cost segregation study can supply the unit of property breakdown used to make these materiality determinations, and that can support you in the event of an audit. So, for example, if $400,000 is spent on a new roof and it's not considered a betterment, and you know from your cost segregation study that the cost is less than 30% of the building's building structure's initial cost basis, you should be safe in taking the roof as a current year expense. So that's new, and it's a very valuable concept that real estate investors should take hold of. Here's an example of applying this idea, basically using the cost segregation methodology to making expensing decisions under the tangible property regulations. Say we have an 80-unit apartment building. We analyze the owner's depreciation schedule and the supporting documentation to determine which of these many post-acquisition assets on there would qualify for expensing treatment, either under the routine maintenance safe harbor or as non-bar, non-material capital costs. So this is a live example, and we found many qualifying expenses on the depreciation schedule. So highlighted in this table just a couple, which were for roof work back in 2008 and 2010. Together, the cost for those two expenses totaled about $95,000, and altogether for this property we found over $900,000 in assets that could be retroactively expensed under the new regulations. Now, the final taxpayer-friendly feature of the TPRs is the ability to expense the remaining tax basis of assets that have been removed from a building. This eliminates a problem, and that's the problem of ghost assets. Those are assets that are no longer in the building but are still being depreciated. And that often happens when, as example, a new roof is added. So if the new roof, let's say it's a type that is considered a betterment because it's fundamentally a better type of roof, and it has to be capitalized, then it used to be that the embedded cost of the old roof just stayed on the depreciation schedule. Now there is an IRS accepted method permitting the write-off of that old roof, which essentially enables cash for trash. The challenge to doing this is coming up with defensible numbers for the cost basis of the assets that were never broken out separately, such as the cost of an old roof. If you buy a building, you don't see it broken down with roof and everything else. It's usually all lumped together. So that's where a cost segregation study can help you, because it can provide separate costs for all the components of the building in a manner that the IRS has accepted for many years. So here's an example of some partial asset dispositions from a high-rise office building. Now, the items we have listed here in this table represent the old assets displaced by new ones. So a cost segregation study was used to determine the individual costs of these assets, and then the owner's accountant took these figures, computed the accumulated depreciation from the time each asset was actually placed into service. Then they were able to write off the remaining cost basis of each retired asset. Now, just as a side note, sometimes cost segregation might be more than is needed to derive costs in a particular situation. The IRS allows in the regulations for the use of an alternative method that's pretty simple. It's using the producer price index as a tool to essentially discount the current replacement costs of items back to the date placed in service. And Bedford has used that method in some cases. However, it needs to be used with caution because sometimes it can produce some very illogical results. So just be aware of that. Just to reiterate, some of these features of the regs that I call the taxpayer-friendly features can be applied retroactively, and that's huge. Now, the routine maintenance safe harbor and expensing of non-bar, non-material capital costs can be applied to prior years with no limit. And you just file one form with the IRS to get that done. That's why it's wise to review the depreciation schedule and see if there may be any capital expenditures booked as assets in the past that might be good candidates for retroactive expensing. The first of the two safe harbors I mentioned are annual elections on the tax returns. So those can only be used on a going ahead basis. And then as far as the asset disposition option goes, that can only be used in the year a disposition occurs. So it's a good idea to review each year whether any dispositions have actually occurred in order to avoid missing the opportunity to write them down. So the cost segregation method can be really valuable to property owners because it brings a combination of expertise in construction engineering and cost estimation and a very rigorous methodology that the IRS respects. It brings that all to this expensing decision process. So that gives you a very solid defense in the event of an audit. I've found that in talking with a lot of accounting firms, most of them, except for the very large ones, have been pretty hard-pressed to master these regulations so far, and they, of course, lack construction engineering skills needed to apply certain aspects of the regulations in a sound manner. So that's why more and more accountants are choosing to rely on cost segregation providers who specialize in this particular area for support. So I want to wrap things up, and I want to do that with a brief case study that will tie all of these ideas together. So I selected a case that I worked on. This is a low-rise office building. It was acquired in 1988 with various step-ups and bases through the years, bringing us to a $9.9 million cost basis at the time that we performed the work. This is an actual case, as I mentioned, and I did the initial review of the depreciation schedule to see what there might be and found $654,000 in historical costs to review as far as expensing possibilities under the TPRs. Now, although the building had been owned for quite some time, I recommended a cost segregation study to, again, like in my first story at the beginning of this presentation, squeeze out all possible remaining accelerated depreciation, but also establish the unit's property breakdown for materiality testing of some of the assets that we were looking at. So the first step was to do the cost seg study, and that yielded a $482,000 catch-up depreciation deduction, which at a 40% tax rate produced $192,000 in after-tax cash flow for the owner. Fairly modest outcome, but it was not the only purpose of the study. So then we went looking for the TPR-related deductions. Here's a look at the unit of property summary. We have $9.9 million in initial cost basis, and that was broken down by the engineers into the IRS-defined building systems. And this was done to assist in performing materiality testing, not only for a retrospective look, but also for future years in case the owner does any significant expenses in the future. So the result of this was that the client basically saved $138,000, which was the combined effect of three types of deductions. They got a routine repair and maintenance deduction of about $70,000, non-bar, non-material capital costs of $262,000, and partial asset dispositions of $212,000. So once we identified and validated all the assets on the depreciation schedule that qualified for expensing treatment, the accountant simply calculated the accumulated depreciation on each of these and came up with the remaining tax basis of $346,000. After-tax basis equated to $138,000 in tax savings. All right, that just about wraps it up, but I want to make a couple of important observations. First of all, know that the TPRs offer some really terrific new expensing opportunities for real estate owners. You can write off the remaining tax basis of many things that no longer need to be depreciated under these new rules. And that's great because it means you can expense some really big ticket items, including things like a new roof if they qualify. But one thing that's gone largely unnoticed is that with these TPRs, the IRS, well, they issued regulations, not suggestions, and they apply to all investment property owners. They're not optional, even if many property owners and their tax advisors have been treating that way so far. The consequences of ignoring these regulations could be expensive. The IRS might look at failure to comply as essentially use of an improper accounting method, and that could result in disallowance of depreciation deductions that should have been expensed in prior years. So the moral of that story is that if you haven't already done so, it would be wise to heed the regulations by doing the appropriate filings, scrubbing the depreciation schedules, and taking the permitted deductions, and then follow these new rules going forward. So to sum it up, cost segregation is a great tool to crush your income taxes by identifying and supporting all of your rightful deductions for accelerated depreciation, routine maintenance, non-bar, non-material capital costs, and partial asset dispositions. If you'd like to explore how Bedford can help you to crush your taxes, then I invite you to get in touch with me. And oh yeah, please visit my blog at cretaxtalk.com and sign up to receive my newsletter to keep you informed. Back to you, Karen.
Thanks, Jeff. That's a lot of information, so to help everyone absorb it, we're sending out both a recording of the webinar and the slides to all of the attendees. This webcast will be repeated next Tuesday, the 26th, in case you have some colleagues who might benefit from it. The sign-up page is at cretaxtalk.com, or you can email Jeff. We'll now open it up to questions, and we'll be here as long as necessary to answer them all. If you have to leave us, thanks for attending, and don't forget to check out Jeff's blog, cretaxtalk.com.